Ladies and gentlemen, I want you to take a deep breath and picture this. The global financial system is wobbling on the edge of a cliff, and most investors don't even realize it. While Wall Street sleeps, the real opportunity is quietly forming in one of the oldest and most reliable stores of wealth known to man, silver. If you own anywhere from a 100 Oz to a 1,000 Oz of silver, what I'm about to tell you could make the difference between preserving your wealth and watching it evaporate. This isn't speculation. It is history, economics, and raw market logic all wrapped into one moment that may define your financial future. You need to understand that the global financial system is not operating under normal conditions. What we are seeing today is not just cyclical volatility or routine market fluctuations. It is a structural distortion embedded deep within the international monetary framework. Governments and central banks have abandoned the discipline of sound money, and the consequences are already unfolding in plain sight. Fiat currencies, once trusted as reliable stores of value, are now instruments of deliberate policy manipulation. Printing presses are running non-stop. Debt levels, both public and private, have reached staggering proportions, and yet these actions are being justified under the guise of economic stability and growth. The reality is far more dangerous. We are living through an era of monetary distortion that threatens to undermine wealth, distort markets, and create profound uncertainty for those unprepared. When central banks flood the system with new money, they do more than just increase liquidity. They distort interest rates, disrupt price signals, and create an illusion of prosperity. Investors are lulled into complacency because asset prices appear to rise, but these gains are largely artificial. They do not reflect underlying productivity, innovation, or real economic value. Instead, they reflect an engineered environment where financial incentives are manipulated to keep markets calm and governments in power. The disconnect between the paper economy and the real economy grows wider by the day. And this divergence is a key signal that the system is fundamentally unstable. Currency devaluation is another layer of this distortion. When a government prints money or manipulates interest rates to weaken its currency, it may appear beneficial in the short term. Exports become cheaper, debt burdens are reduced, but the hidden cost is insidious. Purchasing power erodes quietly. Everyday citizens feel it in rising prices for goods, energy, and housing, but these effects are slow and cumulative, often overlooked until they reach a critical tipping point. Meanwhile, those with assets denominated in real value, tangible assets, hard commodities, are insulated, sometimes dramatically, from the collapse of paper wealth. The system is increasingly rigged to favor those who can anticipate or hedge against the distortions, rather than those who trust that the status quo will hold. One of the most dangerous aspects of this distortion is its impact on expectations. Investors assume that markets are efficient, that prices reflect real supply and demand, and that policy interventions are temporary or reversible. This assumption is dangerous. Central banks have now shown that they are willing to maintain artificial support indefinitely. Bond markets, for example, are propped up not by natural capital allocation, but by central bank intervention. Equity markets are similarly inflated. Even the supposed safe haven of cash or government securities is compromised because these instruments depend entirely on faith in a system that has been structurally weakened. The illusion of stability creates moral hazard, risk-taking is rewarded, discipline is punished, and the eventual unwinding becomes both inevitable and severe. Global interconnectedness amplifies the distortion. No currency or economy exists in isolation anymore. When one central bank manipulates its monetary policy, the effects ripple globally. Exchange rates fluctuate not according to trade fundamentals, but according to policy divergences and speculative flows seeking yield or safety. This creates feedback loops that can exacerbate volatility in unexpected places. What may start as a local intervention quickly becomes a global stress point, creating conditions for sudden market dislocations and crisis. Those who understand this interconnected risk are far better positioned to anticipate shocks than those who assume that central banks can control everything perfectly. The ultimate effect of monetary distortion is that traditional signals used to guide investment and preservation wealth are no longer reliable. Interest rates, bond yields, equity prices, all of these are skewed by policy. The conventional tools used to gauge risk and opportunity are misleading. This is why many investors find themselves underprepared, exposed to forces they cannot control, and unprotected against systemic risk. Only by recognizing that the financial system itself is engineered to distort reality can one begin to make rational strategic decisions. Physical assets, tangible commodities, and stores of real value are no longer optional. They are necessary insurance against the consequences of ongoing policy manipulation. History offers a clear lesson. Periods of extreme monetary distortion invariably lead to dramatic corrections, currency collapses, hyperinflation, sovereign debt crisis. These are not hypothetical. They are the predictable outcomes of a system that has abandoned sound money principles. And yet most people are distracted by headlines, consumed with short-term market movements, and misled into thinking that interventions will always succeed. This is exactly the environment in which wealth can vanish in a matter of weeks or months, even as markets appear calm on the surface. Preparation, foresight, and a clear understanding of monetary fundamentals are essential. Those who anticipate distortion, who recognize the signals and act strategically, are the ones who survive and thrive when the inevitable correction comes. In short, what we are witnessing is not just monetary policy, it is a deliberate systemic distortion of the global financial system. It creates artificial asset prices, her interest currency purchasing power misleads investors, and concentrates risk in ways most people cannot see. Ignoring this reality is perilous. Understanding snorts it, and acting accordingly is critical to preserving wealth and navigating the uncertainty ahead. The clock is ticking, and those who recognize the distortion now will have the advantage when the system finally reasserts the rules of real value. If you think silver is just another commodity, you are missing the bigger picture. What we are witnessing is a structural supply-demand imbalance that the markets have yet to fully internalize. Silver is unique because it serves as both an industrial metal and a monetary hedge. This dual role creates a tension that few other assets experience, and it is a tension that can drive explosive price movements once the imbalance becomes undeniable. Industrial demand is surging, particularly in technology, solar energy, and emerging manufacturing sectors. At the same time, mining production is struggling to keep pace. Mines are old, resources are declining, and investment in new capacity is slow and expensive. The result is a narrowing pipeline of physical silver, a fact that is often obscured by paper markets, ETFs, and derivative contracts. But the reality on the ground is inescapable. Physical supply is tightening, and this sets the stage for a major breakout. Consider industrial demand. Silver is not just a shiny metal for jewelry or collectibles. It is critical in electronics, photovoltaic cells, medical instruments, and a range of emerging technologies. Every smartphone, electric vehicle, and solar panel contains silver, and the pace of adoption is accelerating. Emerging markets are industrializing rapidly, and energy transition policies in advanced economies are driving unprecedented demand for silver in renewable energy technologies. Unlike gold, which is primarily a store of value, silver's industrial use creates an ongoing growing baseline demand that cannot be easily turned off. This creates a floor under silver prices, a baseline of structural and resistant to short-term market whims. Now consider supply. Unlike industrial demand, silver production is not responding dynamically. Mines are constrained by geology, by labor, by environmental regulations, and by capital availability. New large-scale mining projects take years to develop, sometimes decades, and unlike gold, silver is often a byproduct of mining other metals, particularly lead and zinc, meaning that its production is partly dictated by the economics of other commodities rather than silver itself. This creates rigidity in the supply side of the market. Even as industrial investment demand increases, supply cannot adjust quickly. This structural lag, where demand grows faster than supply, is the classic setup for price explosions. Paper markets, futures contracts, and ETFs often give the illusion of abundance, but these are only representations of silver, not the metal itself. Contracts can be created, rolled over, giving the impression that physical supply is plentiful. But when investors and institutions suddenly seek real ounces, the disconnect between paper promises and tangible silver becomes obvious. Those holding physical metal gain a decisive advantage because real supply is limited. The imbalance is not theoretical. It is embedded in the physical constraints of mining, the surging industrial appetite, and the growing role of silver as a hedge against currency debasement. Historically, these supply-demand mismatches have preceded massive price moves. Every major silver rally in history has been preceded by a period in which physical demand outpaced production. And yet, the mainstream narrative continues to underestimate this factor. Investors focus on short-term price trends or macro headlines, missing the underlying scarcity building quietly beneath the surface. Those who understand the scarcity is real and who position themselves ahead of it are the ones who capture the gains when the breakout arrives. Those who ignore it or rely on paper risk being caught on the wrong side of a sudden shift. Another factor exacerbating the imbalance is inventory attrition. Physical silver held in warehouses, mints, and private storage is gradually being depleted as investors take possession or demand for delivery rises. Unlike paper contracts, which can be issued in multiples of the underlying metal, each ounce of physical silver can only be counted once. This creates a tightrope scenario. The moment demand spikes and inventories are insufficient, prices can move rapidly, almost instantaneously. The velocity of price change in such conditions can surprise even sophisticated market participants because the distortion between perceived availability and actual supply is often underestimated. Finally, consider investor behavior. When markets perceive scarcity, behavior changes dramatically. Those holding silver may choose to retain it rather than sell, further tightening supply. Those who are on the sidelines may rush to acquire physical ounces, further amplifying demand. This dynamic, combined with already limited production and growing industrial consumption, is a perfect storm. It is not a question of if, but when silver will respond to these structural imbalances. Timing and preparation become critical. In short, silver is caught in a squeeze. Demand continues to rise both for industrial purposes and as a hedge, while supply remains constrained by physical, economic, and logistical realities. Paper markets and derivative instruments mask the severity of this imbalance, but they cannot change the underlying reality. When the market eventually aligns with the physical constraints, as it always does, prices will adjust sharply. Those who recognize the structural supply-demand dynamics today will find themselves in a position of advantage when the market can no longer ignore them. Silver is not just a commodity. It is a finite, increasingly scarce resource under growing demand pressure. The imbalance is real, measurable, and accelerating. Understanding this is essential for anyone seeking to protect wealth or capitalize on future opportunities. In the months and years ahead, this structural tension will define the trajectory of silver prices, and those prepared will reap the benefits. The markets today are more fragile than most people realize. On the surface, everything appears orderly. Prices fluctuate, trading volumes are robust, and headlines reassure investor that systems are functioning normally. But beneath that veneer, the structure of the silver market is vulnerable in ways that few participants fully understand. Market vulnerability is not simply a function of price swings or investor sentiment. It is a systemic condition created by the concentration of risk, the reliance on paper markets, and the disconnect between derivatives and physical assets. When these underlying vulnerabilities are triggered, they can produce sudden dramatic moves in prices that catch even experienced investors off guard. One of the primary vulnerabilities lies in the dominance of paper silver over physical silver. A significant portion of trading occurs not with actual ounces, but with contracts, ETFs, and derivatives that are meant to represent them. This creates a massive leverage effect. 1 oz of physical silver can be claimed multiple times through financial instruments. For as long as confidence in the system holds, this works without issue. But confidence is inherently fragile. If even a portion of contract holders demand physical delivery simultaneously, the system can seize up. Prices can spike violently, inventories can be exhausted, and the illusion of liquidity can collapse almost overnight. The market is like a dam holding back a reservoir. It appears stable until a crack opens, and then the flood is unstoppable. Another vulnerability is concentration. Both production and ownership of silver are concentrated in ways that amplify systemic risk. Mining production is dominated by a small number of major producers, meaning that operational disruptions, labor strikes, regulatory changes, or geopolitical instability can suddenly reduce supply.